September 1958. Joseph Williams opens his mailbox in Fresno, California. There's an envelope from Bank of America. Inside is a piece of plastic with his name embossed on it. No application, no signature required. It's a credit card. He didn't ask for it. 59,999 other Fresno residents got the same envelope. By the end of the week, Williams will use it to buy groceries he can't afford today. By the end of the month, he'll owe the bank money with interest compounding on money never borrowed. This is the story of how one failed experiment became a trillion-dollar trap that redefined American debt. Inside Bank of America headquarters in San Francisco, executives are watching the Fresno experiment with growing concern daily. It's been 6 months since the mass mailing. Fraud is exploding. 22% of all transactions are fraudulent. Stolen cards, fake purchases, merchants with no way to verify if the card in front of them is legitimate. Kenneth Larkin, the executive overseeing the project, is sitting in a conference room surrounded by angry board members. They want to kill the program, cut losses, admit defeat, go back to traditional lending with applications and approvals. But Larkin sees something they don't. He's looking at a different number. Not the fraud rate, the interest rate. Even with 22% fraud losses, the system is generating profit. Because of one innovation nobody else has tried yet. The minimum payment. Instead of requiring cardholders to pay their full balance each month like charge cards do, Bank of America offers an option. Pay just 2% of what you owe. The rest carries forward with interest. 18% annual interest, compounding monthly. And almost nobody is paying their balance in full. They're paying the minimum. Larkin does the math in front of the board. A customer with a $1,000 balance paying minimum payments only will take 30 years to pay it off. They'll pay $2,200 in interest on a $1,000 purchase initially. The fraud doesn't matter. The defaults don't matter. The interest revenue on persistent debt outpaces everything else completely. The board approves continuation. The Fresno experiment expands. By 1966, it's licensed to banks across America as Bank Americard. But to understand why this worked, you have to go back further, to understand what America looked like before. 1. World War II ends. American soldiers return home. The economy is shifting from wartime production to consumer goods. But there's a problem. Americans don't have a culture of consumer debt. You saved money, then you bought things. Department stores offered charge accounts, but these weren't credit. They were 30-day settlement systems with no interest charges. You bought a coat in January, you paid for it in February. If you didn't pay, your account closed. There was no such thing as carrying a balance indefinitely. Debt was shameful. Borrowing meant you had failed financially. Banks wanted to change that. Not for moral reasons, for profit. The spread between deposits and loans was enormous. They paid depositors 2 to 3% interest on savings accounts. They charged businesses 6 to 8% on commercial loans for equipment and expansion. But consumer loans were untapped. If they could get regular people to borrow continuously at 18% interest rates, the profit potential was unlimited. But they needed a distribution mechanism, a way to lend without approving every transaction. That's what the credit card solved. It wasn't a payment innovation. It was a debt distribution innovation at scale. In 1950, Diners Club launches the first universal card. It works at multiple restaurants and hotels across major cities. But it's still charge and settle. You pay your full balance every month. No revolving credit. No persistent debt mechanism. American Express launches in 1958 with the same model. Charge cards for business travelers and wealthy consumers only. Then Bank of America does something different in Fresno. They don't target the wealthy. They target everyone indiscriminately and broadly. 60,000 unsolicited cards mailed to random addresses, no income verification, no credit checks, just plastic and instant credit limits. The chaos is immediate and overwhelming. Within weeks, fraud is rampant. Cards stolen from mailboxes, fake merchants processing fake transactions, consumers spending beyond their means because there's no mechanism to stop them, no real-time authorization, no spending limits enforced. Bank of America is losing money every single day. The Fresno newspapers are calling it a disaster and catastrophic failure. But Larkin is watching something else. He's watching the customers who aren't committing fraud, the ones using cards legitimately. And they're not paying their balances in full. They're paying the minimum, month after month, carrying debt forward indefinitely. That's when he realizes the fraud is temporary, the debt is permanent, and permanent debt is infinitely more profitable. By 1960, the fraud problem is solved with better verification systems. Merchants get authorization terminals, cards get security features, but the minimum payment structure remains unchanged. Because that's not a bug, that's the entire business model working perfectly. Here's how the minimum payment trap actually works in practice. Let's use real numbers from a real scenario. You carry a $5,000 balance on a card with 22% APR. The bank offers a 2% minimum payment option. That's $100 per month. Sounds manageable. Feels like you're making progress. But here's what actually happens to your money. The 22% APR compounds daily. Your daily periodic rate is 0.0603%. That gets applied to your balance every day. In the first month, you accrue $91 in interest charges. Your $100 payment covers $91 in interest, $9 in principal. Your balance drops from $5,000 to $4,991. You just paid $100 to reduce your debt by $9 only. The second month, the same thing happens. $91 in interest, $9 in principal. Your balance is now $4,982 remaining. At this rate, it takes 447 months to pay off the debt. That's 37 years of monthly payments. And you'll pay $11,187 in interest on a $5,000 purchase, more than double the original amount borrowed initially. This is not accidental. The minimum payment is engineered to maximize the time you stay in debt consistently. Banks don't want you to default. They want you to persist, paying interest indefinitely without ever fully escaping. A customer who pays their balance in full every month is called a deadbeat in internal bank terminology still today. They generate no interest revenue. They cost the bank money in processing fees and rewards program funding payments. The profitable customer is the one who revolves a balance indefinitely, paying the minimum, staying trapped in the cycle. By 1976, Bank Americard rebrands as Visa. MasterCard launches the same year through a consortium of competing banks nationwide. The network effect kicks in. The more merchants accept cards, the more consumers want them. The more consumers carry them, the more merchants have to accept them to remain competitive. By 1980, credit cards are completely normalized across America. Carrying a balance is normal. Paying 18% interest to access your own future earnings is just standard financial life now. But here's what changed culturally. Debt went from shameful to aspirational. It became building credit and financial responsibility language. Banks marketed credit cards as tools for emergencies, for convenience, for rewards, never as permanent debt extraction mechanisms, and it worked. By 2008, total U.S. credit card debt reaches $1 trillion for the first time ever recorded. The average household carries $8,000 in revolving balances across multiple cards. Interest payments exceed $100 billion annually to banks. Then, The financial crisis hits, defaults spike, banks tighten lending standards, credit limits drop, APRs increase for risky borrowers. But the mechanism doesn't break. It adapts. By 2019, total credit card debt surpasses $1 trillion again, despite the crisis. Today, it's $1.3 trillion. 71% of American adults have at least one credit card in their wallet right now. 46% carry a balance month to month. The average APR is now 22%, up from 18% a decade ago consistently. And the minimum payment structure remains exactly the same as it was in 1958, when Larkin first designed it. 2% of your balance, just enough to cover interest, just little enough to keep you trapped for decades ahead. Here's the psychological trick that makes this work so effectively on millions of people every single month consistently. The minimum payment feels like progress. You're paying something, you're being responsible, you're not ignoring the debt completely, but you're not actually escaping. You're treading water. And the bank is charging you rent to tread that water. Every month, you pay $100. Every month, the balance barely moves. Every month, you tell yourself you'll pay more. But emergencies happen, expenses come up, and the minimum payment is always there. The safety net, the trapdoor. The full breakdown of how banks structure rewards programs to layer on top of this is on Luxona Vault. Kenneth Larkin retired in 1975. By then, Bank Americard had become the largest credit card network in America by volume. He never gave interviews about the Fresno experiment, never discussed the minimum payment structure publicly in any recorded way. But internal Bank of America documents from 1960 show exactly what he knew and exactly what he built intentionally then. The minimum payment wasn't designed to help customers manage debt. It was designed to make debt management feel possible, to create the illusion of control while ensuring the debt persisted as long as mathematically and psychologically sustainable over time. It worked. The $1.3 trillion in outstanding credit card debt today is proof the mechanism works exactly as designed. Debt isn't a moral failing. It's a financial product engineered for persistence by some of the smartest minds. The longer you carry it, the more profitable you become. Banks don't want you debt-free. They want you manageable. Just solvent enough to keep paying, just indebted enough to keep generating interest revenue every single month without stopping. That's the game. And most people don't realize they're playing it until they've been playing for decades unknowingly. The credit card didn't create consumer debt. It industrialized it, scaled it, normalized it, made it invisible and comfortable everywhere. What started as a failed experiment in Fresno became the foundation of modern American consumer finance completely and permanently. Not because it made purchasing easier, because it made debt feel like freedom when it was actually the opposite. Welcome to Luxona, the Netflix of finance.